The world doesn't collapse in a single explosion. It cracks slowly, silently, and then all at once. What you're seeing today in global markets, currencies, and geopolitics is not random. It's not chaos. It's the result of decisions made years ago, hidden behind headlines, buried under political speeches, and masked by short-term rallies in the stock market. While most people were watching inflation numbers and interest rates, something far bigger was taking shape underneath the global financial system. Power was shifting. For decades, the global economy ran on a simple idea: one dominant currency, one dominant financial system, and one group of nations setting the rules. The US dollar wasn't just money, it was leverage. It decided who could trade, who could borrow, and who could survive economic pressure. But that system is now under stress, not because it suddenly failed, but because too many countries started realizing the cost of depending on it. Sanctions became a weapon, debt became a trap, and global trade became political. Every time a nation was cut off from dollar access, a message was sent, not just to enemies, but to allies as well. And slowly, quietly, countries began asking a dangerous question: what happens if we're next? This is where the cracks begin. Central banks didn't announce anything publicly. There were no emergency press conferences. Instead, they adjusted reserves. They reduced exposure. They signed trade agreements that didn't require dollars. They bought gold, a lot of it. At first, markets ignored it. Because markets love comfort. They love familiarity. They assume tomorrow will look like yesterday until it doesn't. At the same time, global debt exploded. Governments printed money to survive crises, stabilize economies, and calm populations. On paper, growth returned. But underneath, purchasing power eroded. Assets inflated. Inequality widened. The system survived, but it became weaker. And weak systems don't break from pressure. They break from loss of trust. Once trust starts fading, capital moves differently. Investors stop chasing growth and start chasing safety. Countries stop cooperating and start hedging. Trade stops being efficient and starts being strategic. This is exactly the phase we are entering now. You can see it in energy markets. You can see it in defense spending. You can see it in how nations talk about economic sovereignty. These aren't buzzwords, they're warnings. Because when economics becomes about security, growth always comes second, and this is only the beginning of the shift. As trust weakens, the first thing that changes is not politics, it's behavior. Countries stop talking about cooperation and start acting in self-interest. Trade routes shift. Supply chains shorten. Strategic resources stop being sold to the highest bidder and start being reserved for allies. This is where geopolitics quietly takes control of economics. Energy is the clearest example. Once treated as a commodity, it is now treated as leverage. Nations rich in oil, gas, and critical minerals are no longer just exporters. They are power centers. Pricing is negotiated, not discovered. Contracts are political, not purely commercial. And this directly feeds into currency power. For years, the dollar dominated because global trade demanded it. Oil was priced in dollars. Debt was issued in dollars. Reserves were stored in dollars. That created a feedback loop no one could escape. But now, that loop is being challenged. Not with headlines, but with alternatives. Bilateral trade agreements are increasingly settled in local currencies. Regional blocs are experimenting with settlement systems outside traditional Western infrastructure. Digital payment rails are being tested at the state level, not by startups, but by central banks themselves. None of this replaces the dollar overnight. That's not how power shifts. Power erodes at the edges first. And while this is happening, financial markets are still behaving as if the old rules apply. Stocks react to rate cuts. Bonds react to inflation data. Currencies move on short-term flows. But beneath that surface, long-term capital is repositioning. Sovereign wealth funds are diversifying faster than before. Gold reserves are climbing at record speed. Defense and infrastructure spending are being prioritized over consumer growth. This is not bullish or bearish by default. It is defensive. And defensive behavior tells you one thing: confidence is fading. Meanwhile, global institutions that once stabilized the system are losing influence. Rules are harder to enforce when major players stop agreeing on the rules themselves. Sanctions lose effectiveness when alternatives exist. Trade frameworks weaken when national security overrides efficiency. We are moving from a rules-based system to a power-based system. That transition is messy, it's slow, and it creates volatility where stability once existed. For investors, policymakers, and even everyday citizens, this matters more than any single election or rate decision, because once economic gravity shifts, it doesn't snap back easily. The real danger isn't collapse, it's mispricing. Markets are still assuming a return to normal, but history shows that once global trust fractures, the old normal rarely returns the same way. And the next phase of this shift is where things get even more uncomfortable. Because when currencies compete and trade becomes a weapon, someone always pays the price. In every global shift, there are winners and losers. But they're rarely who the headlines tell you. Strong nations don't always win first. Fragile ones don't always fall immediately. What usually happens is a long delay, where damage builds quietly before it shows up in numbers people can ignore. The first to benefit are countries that control essentials, energy producers, food exporters, nations sitting on critical minerals. In a fragmented world, self-sufficiency becomes power and scarcity becomes leverage. These countries gain negotiating strength. They trade access for influence. They reshape alliances, not around ideology, but around survival. On the other side are economies dependent on cheap imports, stable trade routes, and foreign capital inflows. When globalization slows, these systems don't break instantly. They bleed slowly. Currencies weaken. Borrowing costs rise. Governments step in to stabilize markets, often by printing more money or increasing debt. That buys time, not solutions. And time is expensive. For investors, this creates a dangerous illusion. Asset prices may remain elevated. Stock indices may hit new highs. But those gains are increasingly disconnected from real economic strength. This is how bubbles form during transitions. Because markets price liquidity, not resilience. When money is easy, weakness hides. When conditions tighten, it's exposed brutally. And tightening doesn't always come from central banks. It comes from trust evaporating across borders. Another group quietly absorbing pressure is the middle class. Inflation doesn't collapse lifestyles overnight. It erodes them gradually. Savings lose value. Housing becomes unaffordable. Wages lag behind asset inflation. People don't panic. They adapt until they can't. Historically, this is when political instability rises. Economic frustration looks for an outlet. Populism grows. Policy becomes reactive instead of strategic, and that feeds back into markets, accelerating volatility. This is the feedback loop most investors underestimate. Because finance doesn't operate in isolation. It reflects confidence, stability, and belief in the future. When those weaken, numbers eventually follow. The world is not heading toward a single dramatic crash. It's heading toward persistent instability, where shocks happen more often, recoveries are weaker, and uncertainty becomes permanent. And in that environment, the biggest risk is assuming the past will repeat. Which brings us to the final question. If the old system is fading, and the new one isn't fully formed, how do you position yourself in between? That's what we need to talk about next. When systems transition, clarity disappears first. The old rules stop working, but the new rules aren't written yet. This is the most dangerous phase, not because everything breaks, but because people keep acting as if nothing has changed. That's where we are now. The next decade won't be defined by uninterrupted growth or smooth recoveries. It will be defined by positioning. Nations that adapt early will shape the system. Those that resist will be forced to react under pressure. Economic power will matter less than strategic power. Control over energy, technology, food supply, data, and capital flows will determine influence. Military strength will still matter, but economics will decide how long that strength can be sustained. For markets, this means volatility isn't a phase, it's a feature. Long-term stability will no longer come from central bank reassurance alone. It will come from geopolitical alignment, resource security, and fiscal discipline. Things markets are not used to pricing cleanly. The idea of a single global safe haven is fading. Capital will diversify not just across assets, but across jurisdictions. Investors will care less about returns and more about survivability. That's a psychological shift. And once it happens, it doesn't reverse easily. For everyday people, the lesson is uncomfortable but necessary. The future will reward awareness, not optimism. Blind faith in institutions, currencies, or endless growth is being replaced by strategic thinking. This doesn't mean collapse. It means recalibration. History shows that transitions create opportunity, but only for those who understand the direction of power before it becomes obvious. By the time the headlines admit the system has changed, the advantage is already gone. That's why GEO Finance exists, to look past noise, to track power instead of promises, and to understand money not as numbers, but as influence. Because in the world that's coming, wealth won't just be earned, it will be positioned. If you want to understand how geopolitics shapes markets before markets react, stay tuned. This story isn't over. It's just entering its most important chapter.